Imagine you have $100,000 sitting in your bank account right now. You have two choices: put it into real estate or put it into the stock market. One of these choices over the next 20 years could make you a millionaire. The other one might leave you frustrated, stressed, and wondering where it all went wrong. Most people guess wrong. And today we are going to show you the real math. No sugarcoating, no bias. Just cold hard numbers. Stay with us. Because the answer might completely change how you think about building wealth. Let's start with what most people already believe. Ask anyone on the street, and they will probably tell you real estate is the safest bet. You can see it, you can touch it, you can drive past it. There is something deeply psychological about owning a piece of land or a building. It feels permanent. It feels real. And for generations, buying property was the #1 way middle-class families built wealth in America. Your parents probably told you to buy a house as soon as possible. Your grandparents likely did the same. But here is the problem with inherited wisdom. The financial world has changed dramatically, and old advice does not always survive new math. On the other side, stocks have a reputation problem. A lot of people think the stock market is basically a casino. They remember 2008. They remember friends who lost everything. They hear words like volatility and correction, and they get nervous. But here is what those same people do not talk about. The S&P 500 has returned an average of about 10% per year over the last 100 years. That includes every crash, every recession, every panic, 10% per year. That number is going to matter a lot as we go deeper into this comparison today on Wealth Index. Now, let us do the actual math that most YouTube channels skip over. Let us say you invest that same $100,000 in 1990. If you put it into the S&P 500 index fund and never touched it, by 2024, you would have roughly $1.8 million. That is, with dividends reinvested and assuming that average historical return. No landlord headaches, no maintenance calls, no tenants destroying your kitchen. You just let compound interest do its thing for 30 years and walked away with nearly $2 million. Now, let us look at real estate with that same $100,000 in 1990. The average U.S. home price back then was around $120,000, so your $100,000 could work as a down payment on a decent property. Fast forward to today, and that same home might be worth somewhere around $400,000 depending on location. That sounds incredible, right? You tripled your money, but wait. We have not done the full math yet, and this is where most real estate influencers stop the video. We are not going to do that. When you own real estate, you are not just collecting appreciation. You are also paying for it every single day. Let us break down the real costs. Property taxes in most U.S. states run between 1% and 2% of the home value per year. On a $400,000 home, that is between $4,000 and $8,000 every single year just in taxes. Then there is insurance. Homeowners insurance plus any flood or liability coverage typically costs another $2,000 to $3,000 per year. Then you have maintenance and repairs. The industry standard is to budget 1% of home value annually for upkeep. That is another $4,000 a year on average. And if you are renting the property out, which is how most real estate investors actually make money, you need to factor in vacancy rates, property management fees, and those surprise repair calls that always seem to happen at the worst possible time. A property manager typically charges 8 to 12% of monthly rent. If your property rents for $2,000 a month, that is up to $2,400 a year going to management fees alone. Add it all up, and owning that property could cost you $15,000 or more every single year before you ever see a dollar of profit. Here is where it gets really interesting and where Wealth Index wants you to pay close attention. Real estate has one major advantage that stocks simply do not offer in the same way: leverage. When you put down $100,000 on a home, you are not just controlling $100,000 in assets. You might be controlling a $500,000 property. If that property goes up 20% in value, you have not made 20% on your investment. You have made $100,000 on a $500,000 asset, which is actually a 100% return on your original down payment. That is the power of leverage, and it is genuinely one of the most powerful wealth-building tools available to everyday Americans. But leverage is a double-edged sword, and this is the part that gets glossed over constantly. If that same property drops 20% in value, and we all saw this happen in 2008 and 2009, you do not just lose 20%, you potentially lose your entire down payment and then some. You still owe the bank the full mortgage amount. You cannot just log into an app and sell half your house like you can sell a stock. Real estate is illiquid by nature. It takes months to sell a property, and in a down market, those months can feel like an eternity while your costs keep piling up. Stocks, on the other hand, can be bought and sold in seconds. You can start with $500 instead of $100,000. You can diversify across thousands of companies with a single ETF purchase. You can be completely hands-off or deeply involved in your investment decisions. The accessibility of index fund investing has genuinely democratized wealth building in a way that real estate simply cannot match for most working Americans. You do not need a mortgage broker. You do not need a home inspector. You do not need a real estate agent taking 3% of your transaction. You need a brokerage account and 10 minutes. Now, let us talk about the emotional side, because money is never purely mathematical. Real estate investors often talk about something called pride of ownership. There is a genuine psychological benefit to owning physical property. You can improve it. You can rent it. You can pass it to your children. You can live in it. A stock certificate gives you none of that tangible satisfaction. And for millions of Americans, the discipline of making a mortgage payment every month is actually a forced savings mechanism that they would never replicate voluntarily in a brokerage account.